Hi, this is Robin Tull, and I'm with our Director of Tax and Financial Planning, Drew Overton, and we're going to be talking today about the One Big Beautiful Bill. You know, we're at the Orange Couch, and I'm in a different place here where I'm asking the questions to Drew, but what we do is we encourage clients, friends to send us questions that they're having regarding financial planning. And one question we get is, help me to understand this tax bill that was signed in July. I think that the thing that I've experienced most, Drew, from clients is many of them don't know that their taxes would have gone up had this bill not be signed. Can you expand on that a little bit, please?
Yeah, definitely. So the marginal rates were scheduled to go back up to what they were before the Tax Cuts and Jobs Act. So you think the 12, the 22% brackets were scheduled to go back up to 15 and 25 and so on. Top bracket going from 37 to 39.6. So everyone across that spectrum would have been impacted, and now that's not going to be the case.
Yeah, and you know, one of the questions, if you've been with us client meetings, that we always ask is, do you itemize or do you use a standard deduction? And that was one area that really got changed, isn't it?
It is. The standard deduction for individuals up $1,000, for married couples filing jointly up $2,000. But really, when we look at this bill, the itemized deductions, what's under there, the charitable deductions, the state and local tax deductions, that's where most of the change came from.
Yeah, I saw it. You know, when I first started out, when I first got married, I bought a car because I didn't have enough, and I had to take out a loan because I didn't have the money. I was able to deduct the interest back then and use it as itemized. My understanding is that deductibility of car is still there.
It is. Yeah, for newly purchased cars that were assembled in the U.S. So there's a auto loan deduction for that up to $10,000. Got a friend bought a Honda this year. You think Honda made outside of the U.S.? No, not necessarily. That one was assembled in the U.S., so he does get that interest deduction.
And the other area which was discussed a lot during the campaign were tax on tips, tax on overtime. I believe that got changed significantly too.
It did. That was a big change that came out. So $25,000, that's the limit for tips, as well as overtime is going to be $12,500 per person. But you think of, you know, someone making $20 an hour, but in overtime they make $30 an hour. That $10 difference is where the deduction comes into play, not your base salary. So it's a little different there, but definitely got passed and is part of the bill.
Now you have 3 kids, and I know Phil in our office is getting ready to have a baby in November, and there's this new account called the Trump account for new birth. Tell me about that.
Exactly. Yeah. So any child born this year or later is going to get a Trump account, which is going to be initially funded by the government, $1,000. There's going to be a $5,000 annual contribution limit. You think of kind of a hybrid IRA, right? So IRAs, you have to have earned income. Clearly, Phil's new kid is not going to have any earned income, so we've got these accounts now where you don't need it, right? So you can contribute on their behalf. No deduction for that contribution, though, but we get the tax-deferred growth.
But you still have the 529 for saving for college education. I mean, that hasn't changed, but there's some benefits. They've expanded those a little bit.
They did. The last extension said that, hey, it's not just for college, right? We can do K through 12 tuition. Now they've said, hey, anything like tuition, as well as tutoring expenses, any computers, any supplies, that's included, as well as credentials. So think CFP, CFA, anything after school that you get. Now those expenses are included and can be paid for by the 529.
And we get a lot of questions as it relates to people that have more than one child, more than one 529. They say, well, what if one of my kids don't go to college? What happens to their 529?
Very flexible accounts, right? That account owner where you have the beneficiary as your child or grandchild can always change that. And so that's kind of the flexible part to those accounts. There's also recently passed where you can actually roll some of that into a Roth IRA.
Into a Roth. We're having people to do that.
Yeah, so they're getting more flexible, which means more people are taking advantage of them.
Yeah, I like that, and we started to do that for some people. Now, you know, we always encourage people to have a last will and testament or a trust. The reason I always say that is because, you know, if you don't have a will, the state that you live in has one for you, and it may not be what you want it to have, it may not say what you want it to say. So there were some generous change in the estate tax deduction. $30 million?
$30 million for married couples, $15 million per person. So when you think of, planning for beneficiaries, the tax planning for that used to be, hey, we need to look at income tax planning and estate tax planning. Not necessarily now for those people under that $30 million limit for couples. Now we're looking more so at the 10-year rule that's still in play, right, for any beneficiaries that are non-spouses. There are some exceptions, but we're looking at how do you get that out tax efficiently from an income tax standpoint.
Yeah, and so we encourage you, this is probably a good time to go see your attorney to make sure your will is up to date, your trust is up to date, everything's funded properly, so that you can take advantage of some of these things. I think finally, one area that we have a lot of people that are charitably inclined, and we help them with different strategies there. There was some changes there in the new beautiful bill as it relates to, even if you don't itemize, you can still deduct?
Yep, so for people who are taking that standard deduction and also charitably inclined, $1,000 per individual, $2,000 per person, or per couple, can take that charitable deduction regardless of whether or not they're taking that itemized deduction. Now for itemizers, there's a new AGI, so adjusted gross income floor of 0.5%, right? So just let's say you're making $200,000 of adjusted gross income, that first $1,000 of contributions to charity is not going to be deductible. You got to get over that to start making an impact on your tax return.
Great. And let me finish up the last subject. We have a lot of clients that are small business owners. And there were some significant changes there. If it hadn't been signed, you have this 20% deduction qualified business income. That was extended. The other thing I know that the Section 179, that you can deduct capital expenditures, correct?
Exactly.
Extended that.
So Section 179 extended and increased there. 100% bonus depreciation was also reset there permanently. So a lot of big changes to kind of incentivize business owners to reinvest in their companies, give a tax incentive there. So big changes there.
We've tried to highlight the areas that probably would affect our clients, and so we do want to encourage you. We're gonna also attach some additional information to this link. But if you have any questions, please reach out to myself, to Drew, to any one of our team members, and we welcome the opportunity. We always want to thank you for your trust and confidence over the year, and we hope you finish out the summer wonderfully. Have a great day.